my name's Steve Walker from Promise Money. It is the 1st of February 2021 and I want to give you a quick update on what's happening in the second charge market. Now, it's fair to say that it's been tough and it's been improving over recent months, and from November onwards I think the lenders had really got to a place where they were ready for the second lockdown, so criteria has stayed pretty much the same or has improved. There's some great new products have come along and overwhelmingly I think there's a pent-up demand for second charges, which is due to pop, not right now, but it's coming. It's definitely coming. You know, people are stopping doing those aspirational things. Debt consolidation, that hasn't really kicked off just yet. That's going to happen. Lenders aren't really ready to be 100% confident with their criteria, so they're just holding back a little bit, and consumer confidence is down as well. But as we move out of this phase over the coming months, which I'm sure we will do, we're going to see a real acceleration for second charges. But there's plenty of products out there now. So this is about, well, what can we do at the moment? So very, very quickly, LTVs, 95%, it's still there, okay? So over recent months, scores have relaxed at 95%. New lenders have come into the sector at 95%, and they'll even accept a little bit of adverse, you know, just a few blips here and there. So 95% is still there. There are lenders that will go beyond that. The rates are pretty darn high, and I'm talking well above the 10% marks. But we do have those products. LTIs, 6 times. It's still there. We've got 6 times LTIs. We've got lenders who are working purely on I&E. So in terms of affordability, it's still as good as it ever was, looking at the LTIs purely, okay? And of course, in a debt consolidation scenario, second charge lenders love debt consolidation, so they're not taking anything that's being consolidated is being totally ignored in the affordability calculation. So that is still good. Rates, 3.7-ish. Your starting rates. Typically, there's plenty going on around about 4%. Buy to lets, you're into the 5s, but we've still got some good products at really, really low rates, just as they were before. I think it's fair to say that the scores were hardened a little bit for those lenders that were credit scoring earlier on or last year, but that's eased off a little bit as well. So we're seeing some really, really good rates. Talking of scores, adverse credit, well, it's whatever you want it to be, really. 70-75% loan to value, there's still lenders taking adverse credit. So, and that's heavy adverse, that's paying off IBAs, that's paying off bankruptcies as well. That's heavy arrears and heavy CCJs. So there's plenty of adverse products out there now. This is where the issue lies, affordability. And as you'd expect, just like in the mortgage sector, lenders are looking very hard at the sectors that people work in. But if people are now off their payment holidays, we can do second charges. If they're now out of furlough, we can do second charges. Some lenders will even accept some furlough income. So all of those areas about sector, that it's still tight, but we are getting more business away. I think if people are in the leisure sector, hospitality and retail, you know, lenders are a little bit nervous, and for self-employed, that's quite a tough area as well. But even there, for self-employed, lenders were asking for accountants' certificates or accountants' projections to confirm that the business hadn't been affected by COVID. And accountants just aren't prepared to do that at the moment, because they say, well, how do we know? So even there, lenders are looking at bank statements to see, you know, how they compare to previous year's trading. What there is a real appetite to lend. Lenders want to lend, that's why they're here, but they have to be prudent and they have to be sensible about it, and they have to protect the interests of the borrowers. So they are having to check out and do these plausibility tests around affordability. But that's the main area where the market has been hit. So if you've got clients where the affordability is good, they've not been impacted, or they've been impacted in such a way that it doesn't have a major effect on their circumstances, it's still worth looking at a second charge. So right now, we've got debt consolidation time, we've got tax bill time, we're moving into home improvements time. People start to look at that as well now. So lots of opportunity for second charges, and lots of lenders keen to lend, and criteria, apart from affordability, hasn't changed that much really. So do get in touch if you've got an inquiry, whether it's one that you want to sell yourselves and we'll package it, or it's a simple referral, give us a name and number and we'll do the whole lot. So thanks for that, watching for a few minutes, and I hope you have a good February. Thanks now. Bye bye.